Hi, good afternoon, everyone. Hello.
Hi, Professor.
Yeah, hi, Claudia. Hi. How's everybody else?
Good.
How are you, Kadir? Um, all right. We were in our last class. Oh, before there will be an announcement about the first quiz one going out tomorrow. So please look out for that. Um, All right, continuing from where we left off last time, right? Um, we we are done with the income statement, so we are moving on to balance sheet. But uh, we already talked about the balance sheet a little bit in the last class. Why? Uh, because um, remember uh, I said, income statement is about the profit, but the balance sheet is about the capital structure. And capital structure is basically, the result of uh, how you raise the capital. In other words, the we used, Dell computer manufacturing as an example, and remember we had the sunk cost, uh, initial investment or sunk cost at time zero. Initial investment is the main reason for the total fixed cost. And I told you total fixed cost is mainly about the initial investment. Initial investment is basically the capital needed to fund the construction of the plant and equipment, right? Uh, and I said, obviously, in manufacturing, right, the plant and equipment is the biggest chunk of all its total assets. In other words, um, uh, think about it. You cannot start any manufacturing without the plant and equipment, right? So let's say it costs about $100 million to build a plant, right, and to put equipment into production equipment into the plant, and it costs $100 million. That $100 million is the initial investment, and it's the sunk cost because it is sunk into this business at time zero. And at time zero, nothing is standing on the ground. You have to dig up the ground, basically build a plant, build a factory from the scratch. It will take about a year or two to complete the plant, to complete the construction, right? So you don't have any revenue. You don't have any because you cannot. You don't have any products made yet. You don't have so there is no sales revenue. So um, for about first 2 years, for the first year or half or 2 years, you don't. That initial investment of $100 million is just sunk into this business. That's why it's called the sunk cost. And also because so then how did you raise that $100 million? It can come only from it can come only one of the two sources or the combination, some combination of those two sources, right? It could be, so equity of, it can come only from either equity or debt, right? And if you equity means, of course, shareholders capital, right? Owners capital, right? And So shareholders paid in $70 million. So this is called paid-in capital. Paid-in capital, right? All right, and then 30 million is debt. It's from the bank or lender or creditor, right? Or bondholders. And again, this is just a hypothetical example because in reality, if you are just a startup, if you are a startup, right? And you don't, that's why, you're a startup, you don't have any a decent production facility. That's why you need, to invest. You need to build a big plant, which is determined by the size of which is determined by the size of the investment, size of capital. Now, so in reality, a startup doesn't have any investor, right? Of course, you will find an investor. You will need to find an investor. But, at time zero, right? There's no investor, right? But if ever you find an investor, right, that will be, and if that investor is willing to put in some money into you, that won't be like $70 million. It would be just a couple of $1 million at most, right? Who is going, because a startup is a big question mark, and nobody's going to invest a huge amount of money, right? Even a couple of $1 million is, it's not an easy money, right? You cannot. But anyway, if someone buys your idea, someone, you may have seen the TV shows like Shark Tank, and what is that? Shark Tank is a TV show where potential investors meet. They meet with the entrepreneurs. If the entrepreneurs' ideas are good, then the investors, potential investors, support their ideas, and then make investment, right? It's sort of like matching the investor with the entrepreneur, right? But again, unless you're on a Shark Tank, right? I mean, if you're, you will have to find, and being on a show like Shark Tank is one way, but you never see anyone investing like tens of millions of dollars. At best, it would be just about max 1 million at maximum, right? But slowly, let's say you are able to, first you found a venture capital. Usually, the venture capital is the investor at this stage, right? And the venture capital is literally someone who really takes the risk. I mean, it's an adventure, right? It's an adventure. You never know. I mean, you invest $1 million, and that $1 million may just, you may completely, screw up that $1 million, right? So it's the venture capital is really taking the risk, right? Now, again, this 30 million is from the bank, or now you can sell. I mean, it's not only from the bank; it can be from the bond market. You can sell bond. I mean, only theoretically, but in reality, a startup cannot sell bond, right? A startup is just like the same, just for the same reason as the stock, right? You cannot sell stock in the stock market if you are a startup. You're not accepted in the stock market. you're not accepted in the bond market either. You cannot sell bonds. So the only way you can borrow money, like $30 million, will have to be from the bank. But again, the bank it's very difficult to, as a startup with no track record, no collateral, it's almost unrealistic to borrow money from the invest from the bank, right? Of course, it's from the lender, right, or creditor. But again, we'll have to assume for our thought experiment, for the benefit of our thought experiment, you are able to borrow from the bank, right? So 30 million is your debt, 70 million your equity. Okay, so in this case, the capital structure is 70% equity, 30% debt, right? This percentage, right? This mix of equity and debt by percentage, that's called capital structure, right? And in the last class, I said, optimal capital structure is usually found somewhere between 70% equity, 30% debt, and 60% equity, 40% debt, right? So you have the total assets of 100 million, right? You have the total assets of 100 million. And the reason you have, remember from the income statement, the reason you are paying interest, right? The reason you're paying interest is because of that debt, right? That $30 million debt, that's why you have interest. If there was no debt, then there's no interest, right? Again, you might think, would it be best, not to have any debt? In other words, capital structure of only 100% equity. No, it's not efficient. I said this before as well. Think about it. If this is 100% equity company, right? Equity funded company or equity financed company, then total asset size will be only 70 million, right? Only 70 million. Obviously, smaller total asset size means smaller production capacity, because the size of the plant is determined by the size of the capital, right? Then you might say, you might wonder, do we just equity, should the equity be limited only to 70 million? I mean, can you not have 100 million equity? Yes, you can, but it's harder to raise. I mean, even raising $70 million equity was not an easy thing. Raising 100 million would be, way more difficult and maybe unrealistic for a startup. And if you cannot even, secure 70 million, I mean, in equity, and the longer you wait, right, to raise 100 million only by equity, the longer your business will be delayed, right? The longer your project will be delayed. So that's one reason why capital structure with 100% equity is not necessarily a good thing, a better thing. Besides, when you have 100% equity, capital structure of 100% equity, then um, your return on equity or your earnings per share won't be maximized because of lack of tax shield. There's a tax shield that comes from the debt, which is actually interest is the tax shield, right? Now think about it. Interest lowers the taxable income by as much as interest. So think about it. If there was no interest, the entire EBIT will be taxable income, right? There will be no difference between EBIT and EBT because there's no interest, right? Then consequently, the bigger, you end up with a bigger taxable income, and you have bigger taxable income. With bigger taxable income, you pay more taxes, right? As you pay more taxes, your net profit can go down. So that's why. So anyway, now we know that what capital structure is, and think about it. Why do we need 100 million? Mostly because of plant and equipment, right? Mostly because of plant and equipment. And the plant and equipment is, I would say, in our example, no. And this is the most important part of manufacturing. Without plant and equipment, there's no manufacturing, right? A plant and equipment is, let's say, it costs you 90 million. 90 million, right? And plant and equipment, building and land. Building means office building, right? You can lease the office building, or you can with 90 million, with 90 million, you can build plant and equipment, and probably you can have office building. Land is literally land. It's your factory and your office building stand on the land. You have to own the land, right, to build something on it. So it costs you 90 million. That's why you needed to raise 100 million. Then you might wonder, there's a 10 million gap. That 10 million is called working capital, or it goes by many names. Current assets. I'm not going to spell out every. It's called current assets or liquid assets. Or working capital. Okay, so working capital is basically the capital you need to run the company even before plant and equipment, even before plant is completed. Think about it. There's no revenue until the plant is completed, right? Start churning out the first batch of products and sell those products. You have no income, no revenue until you sell the first batch of your finished goods, right? And this and the construction of plant and building and installing the equipment in the plant, right, in the factory, it will take at least a year or two. It will take at least a year or two. So how would the company be funded in the meantime? Working capital, right? You need working capital. So as opposed to the current assets, right? plant and equipment, right? Building and land, they are called, non-current assets. Or fixed assets, literally, because they are really, fixed. Fixed assets. And what else? Real assets, because they are real. And then they are physical, right? So non-current assets, fixed assets, real assets, physical assets, they all mean the same thing. And they mean basically plant and equipment, right? Um, But then we all understand that this 100 million, of course, we have, total assets of 100 million, right? But then where did this 100 million come from? Well, we know it came from debt and equity, right? And then we know equity, let's say 60% equity, right? Then 60 million came from equity. And then the debt breaks down into current liabilities and non-current liabilities, right? Current liabilities. I'm not going to spell out everything. Current liabilities are basically short-term debt. And then non-current liabilities long-term debt, right? So the debt was 40 million, right? Let's say 30 million out of that 40 million, right? 30 million out of that 40 million is, let's say, long-term debt. And then 10 million out of that 40 is, let's say, short-term debt, right? Then, also on the liabilities and equity side, right? The total will be also total adds up to total liabilities and equity. Okay, I hate to spell out everything, so I'll just total liabilities and equity, right? They must add up to 100 million too, right? They must add up to 100 million. And then the right-hand side, or the asset side and the liability side, right? They must balance out, right? They must be equal. I mean, if they don't balance out, then it's not a balance sheet, right? By definition, it's called balance sheet because the asset side and liabilities and equity side balance out. Okay, if they don't balance out, then you gotta really you gotta look into the data. You gotta look into the source of the data and really find a way to reconcile the asset side and the liability and equity side. If it's not balanced, then it's not a balance sheet. Okay. Now then, let's take a look at the here's the balance sheet, example of balance sheet, right? Here, Before we look into that, so basically liabilities and equity side is the source of the capital, right? It's the source. Source of capital. In other words, where it came from, where the capital comes from, right? And then the asset side, it's use of the capital, right? Asset side shows the use of capital, right? Or in other words, how or in what form how the K is held in. Okay, in what form the K is held in. The capital, $100 million came from equity and debt, and they are held in different forms now, right? They are held in non-current asset forms, right? Like in plant and equipment, building and land, and then 90 million of that total equity and liabilities, right? 90 million of them is held in the form of plant and equipment, building and land, right? And that fixed asset form. Whereas that 10 million out of that 100 million is held in the form of working capital, right? So this is how what balance sheet is showing you, right? Where did the capital come from, right? Where did the capital come from, and by how much? What by what proportion? We know it came from equity and debt, but in what proportion, right? That's capital structure, and then so originally it was all, think about it, originally it was all money capital, right? Originally this capital means money capital. Originally money capital, right? But then it turned into some physical capital, right? And now has turned into a physical capital. And some liquid or some money capital, right? Some of it is still in the form of money capital. Okay, now then let's think about what assets mean, right? What's the so the definition of assets. So what does the assets mean, right? How do we define assets? Assets are basically, can be defined on three levels, right? On the most basic level, assets are, accounting teaches you like this. Assets are what you own and liabilities are what you owe, right? Assets are what you own and liabilities are what you owe. But then that is not, well, here's something we need to be careful about. because, um, of course, assets came from liabilities and equity, right? Isn't that right? It came from debt and equity, right? It's the source. Debt and equity is the source of, the funds, and assets are how it is held. Uh, so the assets are what you own, they say. Uh, Liabilities are what you owe. But then what is equity? And it depends on the question of who you mean, right? Uh, when we say what you own and what you owe, right? We need to define exactly who is this you, because in English language we just habitually and just colloquially say you, but then that you can mean literally the second person, right? Grammatically it means the second person, but also it also means it's a generic you, you know people in general, right? So you can mean, uh, if it is the second person, right? Obviously, that you must be the second person. You must be uh, uh, the shareholders, the stockholders, because stockholders are the owners of the company, right? So then the stockholders own the assets. The stockholders owe debt to the lenders, and the stockholders own equity. So explaining this as uh, if you look at it from stockholders' perspective, just defining it as own versus owe is incomplete, because then what do you have to say here? I mean, equity is not what you own, it's what you equity is not what you owe, it's what you own, right? So having own here and here, um, that's a little weird, but that still makes sense, because assets that you own came from both equity and debt, and equity transformed, which was money capital, transformed into fixed assets, right? Some of it is still probably money capital, which is why it's called working capital, right? Uh, so if you look at it from the stockholder's view, right, it's a bit incomplete. But if you look at it from the company's perspective, right, define it from the company's perspective, then uh, it becomes more clear, because company owns the assets, right, from the company's perspective, right? Then so here, when you say what you own, what you owe, that you is the company. But think about it. Company is not a person. Company is an inanimate entity, right? Company is a legal entity, so it's an inanimate entity. Company cannot eat anything or enjoy the money or any, right? Um, so company is, if you look at it from the company's eyes, right, from the company's perspective, uh, it's true that the company owes a company owes, right, debt to the lenders, and company owes equity to the stockholders, right? That's what it means. But then, the company is a vehicle, inanimate entity, which is a vehicle. A company is a vehicle, nothing but a vehicle. Yeah, don't you think? Have you ever thought about that? A company is a vehicle, right? Vehicle for what? Vehicle for funneling the profit to the owners, right? A company is a vehicle to generate profit and to transfer that profit to the owners, the shareholders, right? So it makes it, when we say assets are what you own, liabilities are what you owe, you have to be careful about what you mean by that you, right? It's certainly not second person, right? Right? It certainly doesn't mean the grammatical second person, right? In grammar, right? It certainly doesn't mean generic you, right? Um, but it can mean the shareholders, or it can mean um, the company, right? And by looking at it from the company's perspective, right? This own versus owe definition is validated, right? Of course, that's the first level of definition of assets and liabilities. One thing that really bothered me in the past was that they say as if assets and liabilities are two different things, right? They said because this is you probably have heard of Robert Kiyosaki. Anyone ever heard of Robert Kiyosaki? Anyone? Are you guys there?
Yes,
Okay.
Professor.
Someone heard about Robert. Claudia, you heard of Robert Kiyosaki, right?
Yeah, I think he's a millionaire or something.
Yeah, he's a
Or
popular
actually a billionaire.
author. Yeah, I don't know if he's exactly a millionaire or, but you certainly because he's a popular author back in the 1990s.
Yeah, I
So
have his book called Rich Dad, Poor Dad.
right, Rich Dad and Poor Dad.
Oh, me
So
too. I have it as well.
oh,
It's yeah,
Nicolay, right? So that kind of reveals your age, right? That kind of reveals 19, 20-year-olds wouldn't have heard of, his name. But if you're about probably, older than that, you may have. But, something that bothers me about Robert Kiyosaki is he was, he's popular author and his book is like a million seller, Poor Dad, Rich Dad, Poor Dad. But then uh, that first came out in the early 1990s, and I actually read his book in 91 or 92, I believe, early 90s. And there was something that really bothered me. Why? Because he was misusing one of the passage that I remember is that you must increase your assets and decrease your liabilities. And that's what bothered me. Why? Because there's no way you can there's no way you can increase assets by decreasing your liability. The only way that can happen is, think about it, both liabilities and equities are source of the assets. That's where assets came from. So what he should have meant was you should increase your equity and decrease your debt. And if you increase your equity by more than, decreasing your debt, then your total your assets will go up, right? So what he should have said was increase your equity and decrease your debt. But he said increase your assets and decrease your liabilities, and that's wrong because now because liabilities and debt and assets are like two sides of the same coin, right? Think about it. Assets can go up. For assets to go up, it can happen only in one of the three ways. One, assets. Okay, so assets go up when debt goes up, liability goes up, and equity goes up. Right? Makes sense. When debt goes up and equity goes up, assets will go up. Right? Or it can go up while keeping, when equity goes up, keeping the liabilities constant. Right? Keeping the liabilities constant. If you raise equity, assets will go up. Or also otherwise, keeping the equity constant and by raising debt, right? Or what can happen is you raise equity, decrease debt, but by increasing equity by more than the decrease in debt, right? If they decrease and increase at the same by the same magnitude, there will be no change. There will be no net effect, right? But only by increasing equity by more than the decrease in the debt, right? You can increase assets. So think about it. That's basically the correct way to describe it, right? But some people think assets and liabilities are two different things, but if you think about it, it's like two sides of the same coin, right? Does that make sense? Any questions and any questions so far? Any rebuttal, right? Or any refute or rebuttal on that? Right? So I was quite disappointed at Robert Kiyosaki at the time. Just a popular TV figure, right? But he had, if unless there was an error, he has a completely, complete misunderstanding of assets and liabilities, right? So anyway, the point is, so we can define assets and liabilities this way, and that's the second level of definition, right? First is what you own, what you owe, right? Second, assets is equal to debt and equity, right? Because assets came from debt and equity. And finally, on the third level of definition is that the assets must generate income. In other words, assets must have income generating power. Assets must generate income, right? Assets must have income generating power. So think about it. Suppose you can have 100 square feet of land. And 100 square feet is not really big, You might, if you think 100 square feet is, a big piece of land. No, it's just, 10 feet by 10 feet. Isn't that right? That's 100 square feet, right? And how big is 10 feet by 10 feet? It's not that big, right? But if you can have this in, let's say, you have two choices. You can have it in the Midtown Manhattan. Midtown Manhattan. Or you can have this in the middle of Nevada. Middle of nowhere. Middle of Nevada. Okay, where would you like to have this 100 square feet of land?
Manhattan.
Yeah, of course, in Midtown Manhattan. Why? Can you explain why?
Because in Manhattan, the land have how can I say it, like a value.
It has asset value. It has
Yeah.
asset value, right?
Yeah.
It has asset value, exactly. Why? Because it's an empty lot. Even if it's an empty lot in Midtown Manhattan, at least you can use it to park at least 3 minis. You may not be able to park a lot of cars, but at least 3 minis will fit into a 100 square feet, right? It generates income. And if you build a parking structure, 10-story parking structure, right? It will generate 10 times the income. You can park 30 minutes and it will generate 10 times the income. Whereas, in the middle of Nevada, nothing, no asset value, right? It doesn't generate any income, zero asset value, right? So that's a very important aspect of asset. It must have income generating power. Right? Okay. The time is 2:52, so it's about time to take a 10-minute break. So let's take a 10-minute break and reconvene at 3:02 or something. Right? All righty. So 10 minutes. Okay. Let's take a 10-minute. I'll stop sharing and turn off the microphone.
fils de Karamuka Kamolabe, il repose à Timbo. Aujourd'hui que non, c'est pas dans sa rencontre que c'est Alpha qui a rénové le palais.
All right, we're back. We're back. So let's take a look at this, right? This Excel file is, it's downloaded from our topics folder, of course, right? In the course materials, right? Topic 2, right? This is the Excel file that I'm using. You should have downloaded that too. So, so suppose our startup capital is I mean we needed $100 million because we need to put $90 million into the plant and equipment, building and land, right? Which are called, non-current assets. I mean, we already know this. Also called physical assets, fixed assets, real assets, right? Because they are. And then 10 million was needed as working capital. And to break down, I mean, non-current assets or fixed assets are easy because it's all physical assets. And what kind of physical assets can there be? Plant and equipment, right? Building and land. There's nothing else, right? I mean, physical assets are basically that. And then, our current assets break down into these, line items, right? And they are sorted in the order of liquidity. And you already understand what liquidity is because we already talked about liquidity in the first topic, right? It means on the very basic level, how easily you can convert any asset into cash. On the second level, it means cash flow. On the third level and macroeconomic level, it means money supply, right? So cash is cash already. So it's on the top of the liquidity, right? And the cash equivalent is a very short-term instrument, very short-term, bonds, very short-term, extremely short-term bonds. And why does it have to be a very short-term? Because only if it is short-term, then the value wouldn't change, the value wouldn't fluctuate. If it is like 1 year, 10-year bond, 5-year bond, 2-year bond, the valuation, the price, right, the market price will fluctuate depending on the interest rate, prevailing interest rate in the market, right? Remember, in topic 1, you learned that there are largely 4 types of risks, 4 types of risks associated with the bond. One is, of course, the default risk, right? Default risk. Second one is inflation risk, right? Default risk is, borrower specific, right? If you lend to only the prime grade borrowers, then the default risk is extremely low. If you lend to only AAA borrowers, and then inflation risk is, not borrower specific, right? It doesn't depend on the borrower. It's just across the entire economy. Third risk was the liquidity risk. Liquidity, right? Unknown borrower, right? Relatively unknown borrower, right? And the fourth risk was what? Maturity risk, right? Maturity risk is, risk of, risk associated with, time. The longer the maturity, the longer, the more the uncertainty. Therefore, the risk goes up, and the risk is mainly associated with, the interest rate, right? Because the longer the time horizon, there's a chance that the market rate, not the coupon rate, the market rate, there's a good chance the market rate will fluctuate. But we don't know that because it's like 10 years into the future, 30 years into the future. There's no way to make an accurate forecast beyond like 2 years. Okay, beyond 2 years. So here, if you want to learn more about the cash equivalents, so cash equivalents are the very short-term debt instruments, right? Short-term bonds, very short-term bonds that don't change much in the in price, right? So there's a link. You gotta, check it out. I don't know if the audio is, you can hear the audio here.
Cash and cash equivalents are items on a company's balance sheet that are either physical currency or liquid investments that can be immediately converted into cash.
Okay, so can you hear that audio?
Yeah.
Okay, good, good. If you can hear that audio.
Examples include bank accounts, marketable securities with short-term maturities, treasury bills, and money market funds. They are unrestricted, meaning they can be turned into cash with little trouble or delay. Unlike
Okay, they also listed stock here, but stock is not a short-term. A stock doesn't have maturity, so stocks are not short-term instruments. They just, I believe it's an error.
Unlike investments such as stock, cash and cash equivalents don't typically change in value very much.
Yeah, see, it says unlike stocks, right? Cash equivalents don't change in value, don't fluctuate in value. So that means, stocks, of course, stock fluctuates in value because, every day you see that.
Change in value very much. They represent a company's liquidity and reveal aspects of a company's operational strategy, both important details for potential investors to consider. Companies use cash to pay debts. The more cash a business has on hand, the less likely it is to struggle to pay its short-term liabilities or to have difficulty staying afloat when sales slow. But it's also important to remember that a company with large amounts of cash on hand may be missing out on the money it could make by investing that cash.
Okay. So where are we? So the cash and cash equivalents are obviously, most liquid assets. So they are on top. And then marketable securities. Marketable securities means what? Stocks and bonds, stocks and long-term bond, right? Promissory note and accounts receivable. I'm going to come back to this later. First, let me talk about inventory. Inventory means, three things for a manufacturer, right? But only one thing for a retail business. So what's an inventory? Obviously, for a manufacturer, you must have raw material, right? Factors of production, right? Capital, labor, and natural resource, right? The raw material is natural resource. And the raw material goes into the production process, right? And out comes the finished goods. So this is the production process. And while it's in the production process, it's cold. What should it be called? The raw material, obviously the raw material doesn't instantaneously turn into finished goods. It goes through the production process. And while obviously, so between raw material and finished goods, what is there? Between raw material and finished goods, what's the state? Think about it.
Production?
What's that?
I said production.
Oh, yeah, but of course, I already said, yeah, it goes through the production process. But then think about it. The raw material turns into something, and then it turns into the finished goods. So what is that middle state? What is that interim or the middle state? Hmm? Obviously, think about it. It will like half assembled state. It will be right, isn't it right? We've been talking about Dell, computer manufacturing. So computers start from parts and components, raw material, right? Parts and components. The parts and components must be assembled. So what's happening during the production process? Assembly, right? Assembly, right? Building a computer is basically assembling the parts and components. So we know it is like half processed state or half assembled state or partially assembled state or whatever. We know that that's what is happening during the production process, but the name for that, while it's in the middle of the production process, it's called goods in process, right? Think about it. What should it be called? It's goods in process or work in progress. Work in progress. What else can it be called? It's work in progress, right? Goods in process, work in progress. Actually, that means, like partially assembled state. But why is this important? I mean, in retail, retail doesn't have the others. Retail has only finished goods, right? This goes to the retail, and the retail's inventory will consist of only finished goods. But the manufacturing's inventory consists of these three different states, and the reason we need to pay attention to inventory is because think about it. Where did this come from? Where did the raw material come from? Where did the raw material come from? First, think about it. Was it for free? Was the raw material just for free?
No.
We just didn't know. Yeah. So where did it come from?
Uh, the equity or the debt, like the.
Yeah. But yeah, it could have come from debt or equity. But look, when debt and equity transformed into that's the source of the capital. Now that's when it was in the source. But when it is in the asset side, what is that called? Oh, what happened? It's back there, right? It came from the working capital, isn't it right? It came from our working capital, isn't it right? That $10 million. I mean, it's the company's, it's the investor's money. I mean, it could have come from equity, or it could have come from the debt. But basically, it's our it came from we paid for the raw material with the working capital, right? Does that make sense? In other words, inventory. So it's the current assets, right? Which is also called liquid assets, also called working capital. I mean, inventory is part of the working capital, right? That it's some of that $10 million went into purchasing parts and components, right? It went into parts and components. And then, so probably the value of this parts raw material dollar value of the raw material, maybe, like 50K, right? But when it is finished, right? When it is turned into a finished goods, then obviously the value of the finished goods would be much greater than 50K. Isn't it right? It could be, 100K. The value of the finished goods will. Why? Of course, finished goods is more than just the sum of the parts. You understand? There's a saying. Um, the whole is greater than the sum of the parts. The whole is greater than the sum of the parts. What does that mean? That means, if you just put together all these parts and components, does that make a computer? No. Just by putting together parts and components, it doesn't make a computer. Obviously, you will have to assemble it in a certain way, right? And that's technology, right? Knowing how to put these, parts and components in exactly in a certain order so that it will work as a computer. That's technology. I mean, you can give, parts and components to some primitive humans. They can or some untrained people. They can probably they can put together parts and components, but it doesn't make a computer, right? To make the computer work, it has to be assembled in an exact way. So obviously, the difference between the value of the raw material and the difference between the value of the finished goods, the difference is called what? That difference is called value added. Isn't that right? The difference is called value added, right? Basically, manufacturing adds value to the raw material. I mean, all the finished goods adds value to the parts and components, right? So it's a critical thing to know how much of that raw material, I mean, how much of the working capital turned into raw material, and keeping track of that and how much it added value, right? And while it, and also, can we put a dollar value on the goods in process? Can we put a dollar value? It's kind of difficult to put a dollar value because while it is still goods in process, it cannot be sold, right? It doesn't have any retail. You cannot put retail price on it, so it's kind of hard. But at least it would be at least equal to the raw material value. At least it should be equal to the raw material value, at least, right? So keeping accounting for all of these, that's a crucial job because otherwise, because this $10 million of working capital, we need to keep a track of where it's going and in what form it is held. Because at least you understand, physical capital. I mean, physical capital, you have something to show for it, right? $90 million, it turned into plant and equipment, building and land. There's a physical evidence of it, right? But working capital, sometimes it can lose track of it, right? You can lose track of, where the working capital went to. So, okay, again, so the inventory, right? Again, retails don't have, goods in process and raw material, right? Because it's retail, only finished goods. Now, promissory notes. What's a promissory note? Promissory notes and accounts receivable What's a promissory note? Okay.
It's like a
Promissory.
contract basically promising something in return for. It's like an IOU.
Yeah, it's an IOU. Yes, it's an IOU. But can an individual write an promissory note? Can you write a promissory note?
Yes,
No,
but I
no.
believe you should get it notarized.
Oh, if you get it notarized, but even if it's notarized, will it have any? I mean, can you use it to buy? Uh, can you take a notarized, IOU and uh, take it to an Apple store and buy something? I mean, will they accept it as a payment?
No.
No. There's the thing. Um, Personal IOU is, a promissory note is basically in B2B, only used in B2B, right? Promissory note, it's an IOU, but used only in B2B, business to business, because if you write an IOU, it's a promissory note, but who's going to accept it? It can be only within your private circle, like family and friends, and even trusting friends, right? Uh, within Between the family members, um, they can accept IOU, but and if a very good friend or family will just, I mean, you may be a very trustworthy, credit-worthy person, but if you are not, they will still accept it, thinking that they will just give the money to you. I mean, they would never expect to get it back. So, for promissory note to have a meaning or have use, it has to be only in B2B and issued by, just like a bond, issued by a company that has, um, that has a credit rating, right? That has so promissory note is basically like a check, right? But it looks like a check. The only difference is that unlike the check, it has uh, interest rate on it, which is APR, right? Of course. And then due date. In other words, maturity, right? And then let's say the face value, 300,000. Okay. And think about it. This is used in B2B, so that means in business to business, buyer pays with promissory note. And if you think about it, uh, in B2B, there can be uh, four payment methods or modality, right? Four payment modality. One, of course, they can pay with cash, but of course, businesses, a buyer, this is in the order of, this is in the reverse order of preference. The buyer prefers to pay with promissory note. Prefers to pay with promissory note. And then they prefer to pay with credit card, if ever. And then check, and then cash. So the preference, right? The preference goes up from the buyer's perspective. The preference goes up, right? As you go down. And then it's the opposite for the seller. Seller prefers to receive cash, and then check, and then credit card, or either and then promissory note. So it's least preferred by the seller, but most preferred by the buyer. Why? Because the the due date on the promissory note is either 30 days, 60 days, 90 days, maximum of it could be 90 days, but theoretically it can be up to 270 days even, right? But normally they don't accept anything like that. If you are the seller, would you accept like 270 days? Anything above 120 days, 90 days, maybe maximum 90 days. Anything above 90 days, they wouldn't accept, right? Usually, most commonly used, 30 to most commonly used. Most commonly used, right? 30 to 60 days. So what does that mean? From the buyer's perspective, you can buy time, right? You can buy time because if you pay with cash, that suppose Best Buy bought 1,000 computers from Dell. In B2B, right? Best Buy is the buyer. Dell is the seller. And we have assumed, that the Dell sells the computer. Dell sells the computer for $300, right? Per unit. And this is, from Best Buy's perspective, this $300 is the cost, right? And they bought 1,000 of them, 1,000 units. So for Dell, this is the revenue, right? And then this is the CGS for Best Buy, isn't it right? This is the CGS, cost of goods sold for Best Buy, because when they sell, they will sell this. Okay, let me write it like this. And when Best Buy sells it, they will sell it for $500. So if they sell all of it, this is their revenue, right? Best Buy's revenue. But this 300K is their CGS, cost of goods sold, right? Now, if they pay this 300K in cash, then Best Buy won't have that 300 anymore. 300K, it's not with them. And Dell will be happy because Dell can put that, they receive 300K in cash and they can use this to whatever they can do. There are many things they can do. One, they can reinvest it. I mean, they can use it to, I'm sorry, first thing, they can use it to use for their payment. Payment of what? Look, they have lots of things to pay. Accounts payable, notes payable, interest, accrued wages, right? They can use this to make those payments. Or if they don't need to make those payments, they can reinvest it. In other words, for their own growth, right? When they reinvest into their own company, right? Or invest in the market, invest in the financial market, right? Reinvest means reinvest in their own growth, right? And otherwise, they can invest it in the stocks or bonds. stocks and bonds, right? And whether to reinvest it in their own growth, or whether to put it into stocks and bonds depends on which one gives higher return. Isn't that right? If their own growth rate, in other words, if their own growth rate is greater than the average return from the stock market, then they will reinvest it in their own growth. However, if the average return from the market is greater than their own growth rate, then they will invest it in the stock market, right? But anyway, either way, let's say whatever they do, cash will be used, very usefully, right? It will be very, but if they receive check, right? If they receive check, it doesn't take that much time. I mean, check will clear in about 3 days to 1 week, right? It will take just about 3 days. So from Best Buy's perspective, paying with cash and paying with check isn't very attractive for them. Paying with credit card, they pay with credit card. It will buy them 1 month because the money won't leave them. I mean, their credit card payment will come in 1 month, right? Generally, promissory notes, that means you can defer payment up to 60 days or up to 90 days. So think about it. Seller, right? If they paid with cash, seller will the seller, Dell, will enjoy these opportunities, right? If they paid with cash, the seller, Dell, will enjoy these opportunities. But if they paid with promissory note, then it's the buyer, right? It's the buyer, the Best Buy, that will enjoy these opportunities, right? Best Buy can use this $300,000 for 60 days, and during those 60 days, they can make, maybe they can find, an investment opportunity that can give them 20% return. So otherwise, even if it is not, they have a lot of options with, they can use it to make payment, something that is urgent, right? They can use it to reinvest in their own growth, or but they buy time for 60 days or so, not for 90 days. Then obviously, as promissory note is the most preferred payment modality by the buyer, then it is the least preferred by the seller. So that's why they pay interest, right? That's the reason for the interest. Well, let's say 10% interest, right? But 10% is APR. So in other words, if you want to defer your payment, you have to compensate for the market interest that the seller will forego, right? Think about it. If buyer wants to buy them time for their own benefit, right? They need to compensate, or at least give some consideration, show some consideration for the lost opportunity or foregone opportunity for the seller, right? For not receiving this in cash. So that's why they pay interest. But interest rate is always APR, annual rate. Remember? So let's say the maturity is, we know APR is 10%. let's say maturity is 60 days. So then that means if they accept this promissory note and hold it for 60 days, then the maturity value, right? It's not the face value, because face value is 300K, but the maturity value will be at maturity. They will get face value of 300K plus some interest. And so how do we calculate that interest? Calculating that interest uses simple interest rate, right? So the maturity value will be calculated as in the first topic, when I was explaining the difference between simple interest rate and a compound interest rate, I already explained something about the simple interest rate. So it's the principal, of course, all maturity values are principal plus interest. Then how do you calculate the interest? It's principal times, right? Interest rate times time. Okay, and then that's interest, right? That's I. And think about it. We can make this, we can simplify this, because it's a common, P is the common factor. The factor out the common factor, then it's going to be 1 plus R times T. And what is T here? 60 days, right? So principal is 300K, right? And then 1 plus, what is the interest rate? 10%. So 0.1. And what is the time? 60 days. What? Do we multiply it by 60? No, we cannot multiply it by 60. Why? Because this is APR, annual. You cannot multiply annual rate to 60, right? Because that's like, 60 years then. So we have to adjust. We have to turn this 60 days into year. And if you turn it into year, right, then it will be 60 over 360, either 360 or 365. But I will, why not 365? I'm not gonna. It's exact interest year and ordinary interest. If you do it this way, and if you have taken business to 10, what simple discount is. This is simple discount. This way, of course, this is going to be 1 over 6. And I have already, pre-calculated this. So I know what this is going to be. So this is going to be 305K. So that means if you hold it to maturity and present it to the issuer, the Best Buy, you will receive 305K, right? But not all the companies are, not all the manufacturers are like this. Dell is a big manufacturer, so they can wait, because they won't have cash flow, urgent cash flow issue. But small businesses always have urgent cash flow issues. They always have cash flow shortage. So most of the small businesses would want to, they don't have to wait 60 days. Instead, what they can do is they can take it to the bank and sell this promissory note at discount. Now that's called factoring. So we're out of time, so we're going to talk about factoring in the next class. Okay, all righty. So any questions so far? Any questions? Any questions?
No questions.
All righty. So if you have
No,
no
Professor.
questions, all right. Thank you, Claudia. If you have no questions, then I'll call it a day. Have a great afternoon, everyone, and I will see you guys on Monday. Okay.
Thank you, Professor. Have a good day.
All right, you
All
too,
right. You're
Professor.
welcome. You're welcome. Take care, everyone. Righty, so I'll stop sharing, stop recording, and